One of the big data center stories of 2025 is the big shift of capacity from crypto to AI computing. In recent months, companies that got their start in crypto infrastructure have signed deals with the largest players in hyperscale AI, winning contracts worth billions of dollars. One of those companies is Applied Digital, which has been one of the busiest players in 2025, signing deals for 600 megawatts of capacity on its data center campus in North Dakota. Our guest today is Wes Cummins, the founder and CEO of Applied Digital, who provides an insider's view on the journey from Bitcoin to AI and how Applied Digital made North Dakota a hyperscale data center market. Let's get started. Welcome to Data Center Richness. I'm Rich Miller, and I've spent 25 years telling the story of data centers, cloud computing, and AI infrastructure. In this podcast, I'm sharing conversations with the innovators building our digital future. Now, here's our show. Wes Cummins, welcome to Data Center Richness.
Thanks, Rich. Thanks for having me.
We're glad to have you on. You're here with Applied Digital, and we'll talk more about you guys and what you do in a minute. We all like to start with what we call the data center journey, which is asking our guests to share a little bit about how they found the data center industry and their background and the journey to this point.
For me, the journey started in late 2020, and it was really not the data center industry that you would look at it for the hyperscale data center industry. It was really we started building in early 21. We started building data center capacity for Bitcoin miners. So very different data center use case versus what we'd seen, with housing servers for business applications or Netflix or TikTok or any of those kind of things. So we specifically started building that. And then we did that in 21 and 22, and over about a 24-month period, we built out 500 megawatts of capacity. We ourselves were never a Bitcoin miner. We just built data center capacity and leased it to Bitcoin miners, and we ended up going the route of hyperscale. But then in 22, I started looking at high performance computing, which was a very different market in 22 than it is today. Hired some people to do that, and then really leaned in kind of and we'll get in more to that to the AI data center builds later in the following year. So the journey was really actually started in Bitcoin data center, and then it's led into what we're doing now in what we call AI factories, which is a large scale version of high performance computing.
It's been kind of a big year for your company. You guys have won a couple of large deals. Maybe tell me about your infrastructure and what you've been some of your successes this year.
Yeah, I would say it's been a great year, and it hasn't been overnight for us. It's not been without some struggle. So back to what I was talking about on our journey as a company and my journey personally, we started this in 2022. We started with the idea of high performance computing. I went and hired some people that were building data centers for Meta at the time. In 22, we started. We tinkered a few different ways. So we thought about retrofitting one of our Bitcoin facilities. We did that. I didn't think that worked well. It was definitely something we didn't want to pursue. And then we moved on to a smaller scale, what I would call a stripped down, like lower cost build, but purpose built. And we started doing that in 22. And come December 22, we all know ChatGPT was introduced then. But what we were doing at the time is we had some GPUs running out of our facility in North Dakota, and we had mostly research at universities actually using it, paying us not a lot, hundreds of dollars to use GPUs for machine learning and deep learning. And then, ChatGPT didn't really change the world for us when it was introduced. It was a really, great, novel, obviously exciting with how quickly it was growing, and anyone who tinkered with it, you understood the excitement. Where the world changed for us was in March of 23 when NVIDIA introduced the H100. We were out marketing our data center capacity. Again, we'd started building this smaller scale 10 megawatt facility and we were marketing that to for lease to customers. Happened to be a great fit for H100. We built 50 kW rack densities, so it was a really good fit. And as we were marketing that, I ended up getting introduced into some AI labs and frontier model companies, and it just immersed me in that industry, which, you know, I know the industry, if you look at it, is not that old, but so this is kind of back at, you know, the beginning of the big takeoff of the industry. And what I was looking at was, you know, people that wanted GPU capacity at that time didn't know anything about data centers. So we offered some GPU capacity, just GPU rental for them. We had some relatively large scale built by July of 23. But when I looked around, I thought to myself, it was really difficult at that time for NVIDIA H100 capacity, or to get your hands on NVIDIA H100s. But I thought to myself that, you know, NVIDIA will fix wafer throughput at TSMC. They'll fix, you know, CoWoS packaging, so advanced packaging for the semis. They'll fix transceiver manufacturing. All of these things will. I've been through that before. I have a long history as a tech hardware investor, and what I saw as the opportunity in the marketplace is once those get fixed and that supply chain is fixed, I was looking at what data center capacity was, you know, mostly available in the market, and then what we were doing on the data center side. And I thought to myself, there's going to be a huge shortage of high power density and the type of cooling you needed for these types of workloads. So I went back to our data center development team. I said, you know, guys, we're doing 10 megawatts. We need to go to doing hundreds of megawatts like we did for the Bitcoin data centers. And so we started that work. And in mid 23, we thought there was no better place for us to go to understand what we needed to build than NVIDIA, the NVIDIA roadmap. We worked, NVIDIA has a data center team inside of the company. We worked with that team. We actually did some work with Cray, which is a unit of HP that has built supercomputers for decades. So we soaked that in and then designed a facility and started building it in October of 23. And that's the facility that turned on last month in Ellendale, North Dakota. And so there was a lot of build up to that. And then we started building a facility on spec, no customer, kind of in the middle of nowhere, which was a stressful time for us. But it was really where I thought that the market was going, and there was going to be a need for this capacity, and it was going to become really the bottleneck in the industry versus, you know, GPUs and networking, which were the initial bottleneck. And so we built that, and then, you know, so that started back in 23, and then breakthrough in 25. We signed that building plus two more at the same campus with CoreWeave. And then if you I think it was back in October. So we've been working with a lot of these customers, a lot of the hyperscalers, and we're mostly focused on the investment grade hyperscalers plus CoreWeave. So that's six companies in total that we're really focused on. And we signed one of those investment grade hyperscalers at our second campus in Harwood, North Dakota last month. We broke ground and started building that in September. And we've done a lot of work around streamlining, you know, the process. Our design has changed. We're on our kind of our fourth generation of data center design at this point. We've made a lot of efficiency improvements, both from a cost perspective, flexibility about how the facility can be used, and then also our supply chain so that we can build these. The first building took 24 months to build. And now we're on a cadence where we can, from breaking ground to turning on for our customer, between 12 and 14 months. And so we've made a lot of changes, and that's really been, you know, it has been a big year for the company in that we signed those contracts. We started a second campus. You know, now we have 16 billion of contracted revenue over 15 years with high quality customers. And now, you know, we'll talk about more about what the future holds for us, but it's definitely been a big year. But there was a lot of build up to that, Rich, is what is really the key there. It wasn't just we hit the scene and all of a sudden 25 has been big. There was a lot of stress and a lot of work that the team put in to get us in the position to have a good year in 25.
Yeah, well, you know, figuring out the sort of capacity bottleneck was a huge and timely thing. A number of companies that have been involved in Bitcoin or cryptocurrency procured a lot of power, and that suddenly became very attractive when we started to see some of the traditional major data center markets become power constrained. I wanted to ask about the North Dakota because that's one of the markets that's sort of emerged, at least in terms of HPC and AI. Kind of, you guys have been leaders in getting that established and getting very large companies comfortable with, putting their data center capacity there. Um, what was attractive to you about North Dakota, and did take what were, I guess, the issues maybe for people in looking at that as a data center market?
What the initial attraction in North Dakota was is we were in the market looking for large scale, low cost power, and North Dakota had that. For these, again, going back to, these were Bitcoin facilities that we were doing, and but for the reasons that have made it attractive for that, there's a lot of other reasons that we think it makes it attractive for the AI factory builds. And so when you look at North Dakota, it produces 8 to 10 times more energy than it consumes in the state. So a huge net energy exporter. When we went into the state, the governor at the time, Doug Burgum, who's now Secretary of Interior, one of his biggest priorities was using the energy that the state produced inside the state for the economic benefit of the state of North Dakota versus exporting it to neighboring states or to Canada. So here we were, and we're a perfect fit for that agenda. And then as we moved into the high performance computing, the AI factories, what was great about North Dakota is not only do we have this abundant power, but there's a lot of cross country fiber routes that run through North Dakota. So you have great fiber connectivity in North Dakota. A lot of people wouldn't have expected that. And then abundant power, fiber connectivity. You have a very business friendly climate in North Dakota, where if the governor, that was Doug's, um, that was one of his key points. And then also Kelly Armstrong, the current governor, he has followed up on that, where you want to develop the economy in the state of North Dakota using the energy that the state produces. So you have a really great political environment, and then a cold climate is, we think, is the best for these types of builds. And we published a white paper back in June that it talks about the amount of operating costs that our customers will save on an annual basis being in North Dakota and using our data center to design, our efficient design, versus being in, for example, southern states. And we estimate that they can save in the neighborhood of 50 to 65 million per year per 100 megawatts. We're talking about 15 years on these contracts, and the scale that we're going to, this is billions of dollars of savings because we can push our PUE. So first of all, the design we use in North Dakota, we don't use water. So it's a closed loop, liquid cooled design. So you fill it up with antifreeze, basically, ethylene glycol, but it doesn't consume water on a daily basis. The facilities, a 100 megawatt facility, a 200 megawatt facility, will consume about the same amount of water as an average household. And that's because you have people in the facility that, use water for drinking water, washing dishes, or whatever that might be. So we don't use water. So he focuses on PUE. Then our PUE, we estimate in that location on an average basis, or average annual for the year, is about 1.18. When you compare that with Texas, you're usually looking at, on the low end, like 1.35, on the high end, maybe 1.5. So you have to use a lot more energy, electricity, to cool the data halls versus a place like North Dakota. We get 200 days a year of free cooling, and then the energy price is typically lower because it's an energy abundant state, and there's a big mix of gas and wind. So a lot of renewables in that state, sixth largest wind producer as far as states go in the country. And so it's a really good setup, and now it's just a matter of getting customers to that state, because the big drawback is it's not a data center region. And Rich, as far as how data centers go, it's like, is it a data center market or is it not? And what really determines that is, are there data centers that are already there, and it is Microsoft there, is Amazon there, and they're not in that state, and they're in the area, but you have to convince them that state is worthwhile to open a new data center region. And now we have two hyperscalers in that state, and once you have two, it's so much easier to get the third, right? The first one is hardest. Second one was hard as well. So now we got one of the investment grade, and I'll just say that we haven't been able to disclose the name of that second customer. But what I have said is it's one of 5 investment grade hyperscalers that we target, and those are in no particular order: Microsoft, Amazon, Oracle, Meta, and Google. And so you have one of those in the state now. And I said publicly that also that we're negotiating 2 other sites with 2 other investment grade hyperscalers that are not the one that we have signed. So if we can get a third and a fourth in the state or in South Dakota, kind of in the region, you turn it into a region. But that was the big hurdle for North Dakota. Every other part of North Dakota really checks the box. And now we've checked the box with having these customers go there. We're turning it into a data center region just by ourselves, and we expect to sign more and bring more hyperscalers into that region. But it's that was the big drawback. But we've largely overcome that hurdle. And if you really look at the hyperscalers overall. So if you look back the last 7 years, it was tier one markets, mostly on the coast, and then they've started to migrate more towards the center of the country. So you already have Google building massive scale in Omaha, Nebraska, and you have Microsoft in Des Moines, Iowa, and other of these locations. So if you have them there, then North Dakota is just above that, right? It's a natural extension. So I think there's a lot more for us to do in North Dakota and hopefully in South Dakota. But it's going to turn into a really fantastic data center region. It already has.
Yeah, it's interesting to see how the geography of the data center industry has evolved over the past couple of years, as folks have been following the power, as they say. Um, uh, Doing as much building as you guys are doing is capital intensive. You mentioned that a couple of the tenants are investment grade, which is something that I think always helps. But what's it been like for you guys to try and line up the capital for these projects? I know you've got some backers who many folks will probably know.
When I look, I kind of have 5 pillars of what we need for our business to be successful. So power is one. We have a great pipeline of power. The people in place, we've put a great team in place. They've already accomplished so much, and I have a huge amount of confidence in our team. Supply chain. One of the other things that we did was we went out, 18 plus months ago, and we locked in a significant amount of MEP, mechanical, electrical, and plumbing on supply chain, so that we can execute on these builds every year. And that shouldn't go like that. I can't emphasize that enough because supply chain is a huge issue. Then you have customers. So we've started landing the customers, and then the last piece, capital. And so if you look from a year ago until now, like our cost of capital, we were basically selling shares, doing public offerings with our stock to fund the build prior to having a customer of this site, because that's what we thought we should do. But our cost of capital, when you look back at it, that was a pretty astronomical cost of capital. So if you fast forward to this year, what we've accomplished: one, we brought in Macquarie Asset Management, I think the largest infrastructure investor in the world, huge experience in data centers. They just sold Aligned Data Centers to BlackRock for $40 billion. And so they have a lot of not only capital, but experience. So we got to bring both of those pieces for us with that partner. So Macquarie's committed $5 billion of equity capital for us, and that $5 billion of equity capital, then you think of when you're building a data center, just like your home, right? Any building, but think of your home. On your home, when you go and buy it, you put 20% down, and then you borrow 80% on your mortgage. And we do the same thing with data centers. So the Macquarie capital is the 20% down, and then you borrow the rest of the capital. Once you have a customer and a contract and guaranteed revenue, you can go and borrow against those with lower cost of capital. So Macquarie really unlocks up to $25 billion of capital, that $5 billion, for us to go and to build out. And then last week we did a bond offering that's directly on the Ellendale site. So it's not at the corporate level, but it's down at asset level financing. That was 9.25% on financing, and so that's the CoreWeave site. We've announced that it's CoreWeave. So that's our one non-investment grade customer. And so you expect the cost of capital to be higher for the non-investment grade. But when you compare that cost of capital to what we were doing 12 months ago, we not only have we increased our access to capital dramatically, but we've brought the cost of capital down. If I had to say what our equity cost of capital was to do, continue to build the first building, it was definitely above 50%, right? So if you go from above 50% down to now we're doing 9.25 on debt, we have the Macquarie equity in, which controls the dilution at the top co because we are publicly traded. So for people who own shares, they know we've done a lot of dilution over the last year, and now we've been able to eliminate that with the debt financing and with the Macquarie add-in. So as we go to our second campus with the investment grade hyperscaler, we announced Macquarie's already funding over $700 million there, right? So it's a huge amount of funding that's going in, and this is so that we could go forward, and then we'll put the project financing on top of that to finalize that. We don't have to go out and just sell shares in the market to fund this. So we've dramatically lowered our cost of capital and our access to that capital, and we expect, that's 1 year of improvement, and then if you look out another year and another year after that, we're going to bring a lot of these assets online. You get the revenue ramp associated with that, the earnings associated with that, and we think we'll continue to significantly drive the cost of capital down for the company and improve the value to our shareholders.
Obviously, these are big wins for the company, and again, just quite a 2025. So it very much seems to validate the whole shift to HPC and AI. But I wanted to ask about that sort of decision process. You'd been working in Bitcoin and crypto and offering hosting space for folks there. How did you wind up? What did that decision look like? Was it just about economics? Was it about the opportunity? Tell me a little bit about the thinking that went into making that shift.
When we built out the Bitcoin facilities, we had that really, I would say, dialed in. So, when at the start, we're really focused on, okay, how do we design these? How do we build them, procure power, all of those pieces as you would expect. And then once that started working really well, for me as the CEO of the company, I started looking at, okay, what's the next leg for Applied Digital? And that's when I said, I think the next leg is expanding into high performance computing. But back to the earlier part of the interview, when we expanded, that was a very different market. So we thought the initial expansion would be 5 to 15 megawatts at our current campuses. We'll be able to do graphics rendering, we'll do drug discovery, we'll do image processing. Those were the kind of things that were in the high performance computing market at the time. Could be aerospace design, auto design, but it was a much different market than it is today. But it was just the natural evolution of, okay, we have the Bitcoin mining business now. What's the next step for our business? It was high performance computing, and so we started to work through all of that when the AI portion really hit for us. And then because we were so close to that market, I think we saw it, well ahead of a lot of other people, the need for the data center capacity. So we started building it earlier. But there was, I will never not say there was the big luck portion in this for us, because I expected the high performance computing market to be a nice add-on to our Bitcoin data centers. I didn't expect it to be this big, this fast. And the thing that we've done is we put ourselves in a place to take advantage or capitalize on that market. But not only were we in that place, but we have scaled the team, we've scaled construction, we've scaled capital, we've scaled everything to take advantage of that. But there was definitely that stroke of luck that came through with ChatGPT and then the H100 and kind of what's happened in the evolution of the generative AI market that has really propelled our business.
One of the things I'm interested in when I get to know a company, I'm always kind of curious about their data center design, because for me, it's looking at the data center is kind of a prism tells you a lot about the business and how you sort of prioritize what your customers are looking for. I know back in the day when Bitcoin was and cryptocurrency mining was starting to scale, the facilities were kind of different than your traditional enterprise data centers, kind of focused on cost, maybe didn't necessarily need the same level of redundancy in places. Um, so I'm interested in how you guys were building for crypto and how your design sort of evolved to be able to work with the NVIDIA AI factories.
Saying that they're different, like, I want to put a really emphatic point of it's night and day difference. And we learned that back in 22. As I've mentioned, we said, let's see if we can retrofit our Bitcoin facilities to do high performance computing. We did a little bit of that, and we went away from that really quickly. It's just so different, and we said, look, we need to design something like a new build. We can't do it in the same buildings, because Bitcoin, just to compare this, and I think we've built really great Bitcoin facilities for Bitcoin facilities, but it's all about cost. It's about cost, and when you build, there's absolutely no redundancy from an electrical perspective. Cooling is pretty rudimentary. If you looked at our buildings, it's a long, metal shed that's about 30-35 feet tall, and you put a row of Bitcoin miners just in the middle of it, all the way to the top. And then on one side, the wall is completely open, but you have filters to filter out, dust, particulates. But it's definitely not a clean room filter, because these ASICs are pretty robust and they can take a lot. And then on the other side of the other wall, it's completely open too, where the air just blows through the entire building, and it's long, skinny, and air blows through the entire thing. And in North Dakota, in fact, so we built one in Texas. In Texas, you put fans in to pull air through, but in North Dakota, because of the climate, you actually just use the fans on the back of the servers to pull the air through. So you don't even put anything in for cooling besides you open the walls up. So when you go from that to running what's much, much more like a clean room environment in a high performance computing facility, because the equipment is very expensive, and even if you make the GPUs very robust, like, memory is not robust, right? If you look at Bitcoin miners on board, there's no DRAM. And so that's usually one of the more finicky pieces of hardware on the board that you deal with. So you have to completely change the environment. You have to control humidity. You have to control all of these, and temperature. And so that's why we went down a different path of building. And then, I've said this many times, and I'll say it again. You can retrofit Bitcoin facilities to high performance compute facilities or AI facilities. You're just best to start with a bulldozer and knock it to the ground, and then repurpose that power in a building that was really specifically designed for this. So we went through that iteration, and then as we've gone through, that we built that streamlined facility that was 10 megawatts in Jamestown. And then by the time we said we're going to build this at large scale, like I said, we worked with NVIDIA. We designed this around, it wasn't named Blackwell, but we designed it around the Blackwell deployments. And so that's specifically what the building number one is designed for. 100% liquid cool, could do 25% air cool. And as you know, and for some of the people that listen, if you're not the big data center geek, the air and liquid cool percentages, you can go to 100 and 100. So that's 200 combined. But then the customer decides, right? It only ends up at 100. Do they end up using 50-50 or 65-35? But you provide some flexibility for your customer that's going to go into it. So, and then what we've done from there. So in our standard build now, we've made even significant improvements from the first build, and I hope we'll continue to make improvements, because I'm just a big believer in continuous improvement. So what we've done from there until what we're building now is we've dramatically increased the flexibility inside the facilities. And the reason we did that is we qualified the building in North Dakota with 3 investment grade hyperscalers plus CoreWeave. And then we had others look at it. And we've had conversations with all the 5 investment grade hyperscalers, in depth conversations, technical conversations, plus CoreWeave. So these 6 companies. And the reason we increase the flexibility is each one of them is different. And so we want to build something that we can get any of those companies as customers for. And they're all different in, how many CPUs do they pair with the GPU? Do they use liquid cool on their network racks, or do they use air cool on the network racks? How do they cool storage? How much storage do they use per GPU or per CPU? So they're all very different in how they deploy inside of these facilities. So what we did on our standard design now, and the learnings we had from the first one, we've actually significantly increased the floor space in our data halls. And we have increased the air liquid mix. So now liquid is, still it's 98%, so roughly 100%. And the air mix is 65. So that gives a lot more flexibility in the facility. And then I said we made the data halls bigger. That doesn't typically makes sense, because if power densities are going higher, why would you make the data halls bigger? We want to future proof these as much as we possibly can. So if there's some big breakthrough in the future and power, like the power density need goes down, we're the building is not the most expensive part of what we're building, especially in North Dakota where land is not super expensive. So we just increase the flexibility, and then we spend a lot of time thinking through the future proofing of our data centers. And we mostly still look at the NVIDIA roadmap, but we look at what we're going to need for cooling, power densities, all of those things, and looking at how, okay, we need to make sure that this design, while it's going to deliver at 415 volts right now, we need to be able to deliver at 800 volts in 2 years, right? Because that's the roadmap. And so we've spent a lot of time on data center design to make sure that we can do all of those things and do it as efficiently as possible. And again, we were one of the first, if not the first, with the closed loop liquid cool, so we don't use water. You're seeing a lot of people move to that. I think you're going to basically see everyone move to that, because for data centers, they get a bad rap for using a lot of electricity. That I don't think that's going to change. But historically, they've used a lot of water as well for cooling, and so if we can control that, it's much more. It's actually cheaper, especially in North Dakota, for us to do that. But it's just much more mindful from a resource perspective for our company and then our customers who are going to be in there, and we're in this together. So we want to make sure that we're doing everything we can from an environmental perspective to provide the most efficient facilities while using the least amount of resources possible. And the way you use less electricity too, the more efficient your design, and then also deploying in a place like North Dakota. So for 100 megawatts of data center critical IT load, I need 118 megawatts in North Dakota, where I might need 150 megawatts for 100 megawatts in a place like Texas. So, but that just to give you an idea, I know that was long, but on just how we think through design and how our designs evolved over time.
Oh, that's okay. With me, you can totally nerd out about design. It's interesting, because there's a lot of discussion about making the facilities flexible, particularly now that where we have, as you mentioned, there are some big changes coming, both in terms of the density that we see on NVIDIA's roadmap. It's good that they're putting a roadmap out that's pretty clear about this, because some of these changes need folks to adjust, like obviously the 800 volt, the power distribution is a big deal. It's a big thing. But earlier in the year, I was talking with, I think it was David Liggett, and he said, well, the big thing is going to be fungibility, the ability to adapt to your building to a couple of different ways of approaching things. And now in this last round of earnings calls, I heard I heard that the CEOs of a couple of the hyperscalers talk about data center fungibility and how they want to be ready for lots of different things. So along those lines, and I'm sure that people have asked about this, um, there's training has been the focus of a lot of the data center build lately, but there's also been an increase in inference, which is really I think where a lot of where a lot of the money is going to get made in AI. And there's differences of opinion, I guess, about how big a role latency plays in all of that. What's your thought, being in North Dakota, about what the future course of inference might be, and how facilities are going to adapt to that?
I actually have a fairly strong opinion on this, just because we're on the front line and we're working. So we don't only work with those hyperscalers that I mentioned, but we spend a lot of time with the actual frontier model companies. And they're the big end users of this. And so we want to understand, what are they thinking about for the future and deployments and design. And we spend a lot of time on super large scale designs of how we can get lower cost of data center builds, looking at things like, well, what is it if we build 5 gigawatts at a site or 10 gigawatts at a site? And this is a big theoretical exercise of how we can lower our cost and do, like shared redundancy and these types of things. So that gives us a pretty good look into, the thought process around these things. So first, I'll say our facility in North Dakota is qualified by 4 different hyperscalers, 3 investment grade hyperscalers, as a mixed use facility, so training and inference. And then when I look out to what I'm seeing with the frontier model companies, they only are talking about inference at these large scale sites. And why is that? A, you build them at scale, the single location is cheaper. And B, these companies, so the data center is one piece, but the compute, the actual, if you're using NVIDIA GPUs and using all that network gear, that's the most expensive part by far. And so that's the most expensive part, you want to get maximum utilization out of that. And so a lot of the contracts like OpenAI has, for example, they're paying for 100% of the hours, 24 hours a day, 365 days a year. Those are their offtake contracts. So if they're paying for that, they want to use 100% of the capacity on those GPUs for those hours. And so putting them at a large scale site where it's fungible between training and inference makes an ability to use that much easier. And when you think about this, Rich, is you know inference in the US, if you're doing localized inference, your utilization rate for 8 hours a day while people are sleeping is going to go to almost zero. And so those GPUs could be doing training that entire time. But if you put them at a site like ours, where it's networked correctly and it's at large scale, you can just switch those back and forth. I've read that Grok, for example, is doing inference for the entire world out of Memphis. You don't notice the latency issue. Now, I do think in the future, there will be inference applications that are much more latency sensitive than the large language models, and you will need maybe some what I call CDN style inference, right? The same way we deliver Netflix or YouTube, and you'll get those in the metro areas, right, where your population centers. So you could see that more in the future, but right now, I think for the next couple of years at least, the inference is really going to be built out primarily at these large scale sites, and they're going to be mixed use sites, and they need to get the maximum usage out of these GPUs because that's where all the cost is.
I want to ask about, I always wrap with asking folks to talk about the road ahead, which, given how much change we've had over the past few years, is always kind of an interesting thing. Uh, Obviously, I understand you guys have a lot of runway yet in North Dakota to sell and build out. At the same time, the companies you're working with have very large appetites for capacity, and when they find folks that they like to work with, lots of times there's opportunity. How are you thinking about Applied Digital's future? What you're doing in North Dakota, and maybe what's next after that.
Yeah. So for us, the future, the focus, what seems very clear to me right now is just the demand environment is extremely robust. So that's great. Where we've positioned ourselves is, we're qualified and onboarded with the majority of these investment grade hyperscalers plus CoreWeave. We're working on multiple sites that we're negotiating with them. And if I just look at the business strategy for Applied Digital, so we have 2 campuses now, negotiating additional campuses, and we've said that. And so I have a high amount of confidence we'll get more of those campuses, but it'll be great to get them with additional new customers. So if I look out 6 months from now and I could have 3 additional customers at 3 additional campuses on top of the ones I have, now I'll have 5 campuses. All of our campuses go to a gigawatt over time. And, as I'm sure once you have one of those hyperscalers on a campus, it's so much easier to get them in a second building on that same campus than it is to get them to a new location. So then I'll have a pretty clear roadmap if 5 campuses that go to at least a gigawatt. 5 gigawatts of build, giving whatever the market dynamics are at the time, over call it through 2030 or 2032. I mean, that, as you know, is a massive amount of build. But the goal right now is, number one, execute on what we're doing right now. Like that is really the top priority for us. So build what we've contracted, deliver it on time, because I think you're going to see a lot of late delivery issues in the industry, especially as we get in the second half of 26. I think there's been so many things that have been promised that won't be delivered on. So we're delivered on time for CoreWeave. We'll continue to deliver on time. We'll deliver on time for our second customer. So that's number one focus. Number two is new customer at new location. And so if we get those new customers at new locations, also diversify our customer base. And I think there's a pretty clear path for us to get to 70 or 80% of our contracted revenue from investment grade hyperscalers over the next, call it, 12 to 15 months. And that's a lot of work for us here at Applied Digital, and that still sets us up for an amazing amount of growth in the future. But it all is going to be underpinned by the actual execution.
Well, listen, it's I know it's been a lot of work and it's been quite a journey thus far, but it's nice when a plan comes together. So congratulations on the success this year. I've really enjoyed this conversation. I'm as someone who's been studying the transition and just the sort of growth of AI, looking at the way that you guys have approached this and the whole sort of repurposing of crypto, capacity and crypto companies to be able to pivot and supply all this capacity to the hyperscalers has been one of the big stories in the sector. So I appreciate you coming and sharing your experience and your journey with our audience.
Absolutely, Rich. Thanks for having me. I appreciate it.
And for our audience, for our listeners, thanks so much for tuning in. I know everybody in the data center industry is keeping really busy, so I appreciate you taking a few minutes to listen in and learn a few things about Applied Digital's journey. If you enjoyed the conversation, be sure to smash that like button and be sure to subscribe so that going forward, as we have more conversations, you can stay current on Data Center Richness.